Share price potential. Our potential, I say this one year after year, and we've actually, over the past year, kind of demonstrated a little bit of what our potential is, and I view it as literally unlimited. One of the things that we continue to leverage is the operating model that we have. Even with all the growth in this past year, we added the CRE team at the beginning of last year. C&I has come on at the end of last year here in the first quarter. The massive growth in infrastructure with the employees on the mortgage side of things, we are still operating below our peers on the non-interest expense category. So through first quarter, we're still not what we were traditionally, being closer to 100 points, but this will change geometrically. Connie's team of 6 has $10 million in assets, offsetting them on the balance sheet. When that gets to 100, that number will come back. So all the big ticket expenditures are kind of out there, both from the data processing software things that I've talked about, all the management and staff additions. So we're kind of locked in at the current time for doubling down on everything, so that number will move back down into the 100s versus the 200s as we continue to grow the asset size. It will only get better with time. Slim chance second quarter might be kind of in the same vein because we're still adding a couple more bodies to the infrastructure, but it will, without a doubt, increase and get better over time, which leads to the next ratio of the efficiency ratio. Again, it still beats the peers, even with a 42% increase. Efficiency ratio is kind of the effectiveness of the employee base. Even with all the additions in the mortgage area and the lending area, our efficiency ratio is still better than peers with that 42% growth in the body count. It will also improve in the future as the assets continue to grow and the earnings continue to improve with the CRE and C&I loans. As of 3/31, we're trading 49.5% of tangible book. Believe me, I'm not happy with that. Nobody's happy with that. That's an ongoing discussion at every board meeting. What can we do to improve that? Some thoughts and processes as to why it might be in that place. I mean, when you take a look at the bank itself, even compared to peers, compared to the banking industry as a total, our stock performance is kind of inconsistent with the performance of the bank. All-time high on capital levels, credit quality, management, asset growth, et cetera, and we're not being recognized in the market. Whole lot of reasons for that, potentially. Primarily, probably limited shareholder liquidity. At the current time, we're a bulletin board stock. There's not a massive amount of trading. So that creates a problem, and just people getting locked in or tied up on the shares and not be able to exit with time. Net interest margin, again, is a figure that a lot of folks really judge a bank. If you look at any one character, it's that net interest margin. They don't take into consideration our lower cost of delivery and all the other things going on in the bank. And again, that's getting better, and I think that's helped our performance over the past year. Will we ever match them? I don't know that we will. But you know, it's getting better and closer. So again, that square peg round hole is probably an issue. And just bottom line, banks as an investment choice by particularly individual investors right now is a pretty scary game. They don't know when the other shoe is going to fall. There's a lot of question about the community bank market. Are they safe? Are they solid? What's going to happen out here? So we're just kind of having a bad market at the wrong time, doing great, and everything's here. And you know, when the investors come back, hopefully we'll reap the rewards of that. I can tell you we have taken a look with the passage of the Jobs Act here recently that obviously changed some of the public company requirements, both from 404 reporting as well as other issues in size and scope and whatever. So we are taking a look at the decision, if we made it to the NASDAQ, is it worth that for us today? Historically, that's an expense that really wasn't justifiable. In today's world, it might be. So believe me, we're exploring all alternatives for the bank. The share price and trading volume, it has gone in the right direction without question over the last year. We finished the year at about $10 a share until about 3:35 last night. We were at $16 a share. I think we had 1,000 shares trade at 500 at $14.60, 500 at $14.50. So we had a little drop off last night, but it's definitely gone in the right direction over the last 12 months. And hopefully, as we continue to put out earnings announcements like we did the first quarter and show that it's not a flash in the pan, it really is ongoing, that will enable us to continue to move the share price up. When we compare ourselves to the peers, this is a little bit hard to see, but the blue line is the tracking of our shares. The red line is the NASDAQ and what their percentages of growth and update has been, and the green line is the banking community. So in some respects, we're beating the KBW banking index handily. They're still falling off while we're growing tremendously. So we're not satisfied, but I guess we're doing better than the rest, is the message that this slide will tell you. Enhancing the shareholder value. Obviously, we're continuing to grow the balance sheet. We're at $610 million. Tier 1 capital ratio is still above 8%. We're very solid internally in the bank. We continue to increase the assets, and we still have a lot of room to reposition the balance sheet. We have a large investment portfolio that we can move into consumer and commercial lending. We have a significant amount of cash on hand. We do have fairly solid repayments on our balance sheet on a monthly basis. In fact, until just the last couple months, we were actually repaying more than we were originating. So cash is not an issue. There's no real problems of any sort on our world on the balance sheet today, and we're still targeting the goal of $1 billion in assets by the end of calendar year 2015. We continually look at new revenue channels. Obviously, the success of the mortgage product has got us looking at other sources of fee income. What can we do to leverage what we've done? I just spoke at a conference for SNL in Florida a couple weeks ago. There's been some inquiries by folks there that are community banks that cannot do consumer mortgages, need to offer the product but don't have the expertise in playing inside. Can we kind of private label our mortgage origination service and make it available to other institutions? Obviously, again, the growth of low-cost commercial deposits will help us on the earnings side of things, and continue to explore other opportunities. From SBA lending is a great fee income program right now. The insured part of those loans are being sold on the market for a 13 to 14% premium on average. Student loan program, there's some things we can hook up with some national suppliers there, just kind of take a fee income, kind of round out our suite. And mortgage servicing side of it. Today we're selling it service released. If we kept that servicing product in-house and actually took care of the day-to-day operations side of it, there's a fee income potential for us there as well. Obviously, one of the ways to enhance the balance sheet and to work our game is potential acquisitions. Obviously, the Landmark acquisition we made a few years ago was a tremendous acquisition for us. It morphed into the mortgage origination product, and it was extremely accretive to the bank's operation. Right now, there's an opportunity in the community bank market. As I'm out and more visible and talking to more shows here recently, I run across a lot of community banks. Several of them here in central Indiana are basically strapped with a tarp overhead and cost, and there's nothing for them to do. They can't go to the marketplace to get new capital to replace the TARP. It's a 5% dividend today, soon going to 9%. They have to get out. My analogies, they're kind of like playing tennis doubles. They're 3 feet off the net in no man's land, and there's nothing they can do. They're just going to get screwed whatever happens to them. So there could be some real opportunities here in the small community banks to pick up either organizations that have other asset opportunities, as we did with Landmark and the mortgage lending. Maybe we can find a community bank that has a large SBA program or wealth management services, and with limited physical infrastructure that we could kind of roll into our model without blowing up a lot of infrastructure. So we're exploring all kinds of opportunities and avenues in this space, and we're kind of rolling on the 4 metrics of our business mantra on a day in and day out basis in all of our meetings. Maintain the strong capital position. We had a conversation with the regulators yesterday morning. They're getting ready to come in for their annual review and meeting. I was asked point blank by the regulator the question, Dave, you kind of like to leverage the balance sheet a little bit. What do you think about that 8% Tier 1 capital ratio? I said, yeah, basically I like it, but let me tell you, if I have a chance to bring in $40 million in commercial deposits that are no cost to the institution, it's going to knock me under 8% for a couple months, I'm going to take the $40 million and I'll send you a note and explain to you why. Obviously, capital is key in today's world, and particularly for outside visibility on the bank. When folks look at it, is that tough high ratio. It's kind of tough to get the right earnings and leverage as much as you can, but it's a kind of a good housekeeping seal of approval that we don't want to break. Generating high quality assets. We are not going to make the sins of some of our peers and move further down the food chain and making marginal loans or making bad decisions on the investment side, chasing rate and not paying attention to the quality of the assets. We'll give up a little bit on the earnings side to make sure we get good quality assets on board. Every day of the week, we work on improving the efficiencies within the organization. I would tell you, and again, based on the folks I just talked to in Florida, they were oohing and ahhing at our numbers. We're as efficient as any bank in the country, but there's always room for improvement. We continually look to technologies and services. If a machine can do it faster, more efficiently, and do it 24/7 over a human, we'll let the machine do it and use the humans to help humans. Hopefully we do the first three right. The end result is going to be to enhance the shareholder value. We all want to see that number go up. Trading at book for the first time and probably almost since inception would be huge. We'd love to get back to that level and obviously create great value probably for everybody sitting in the room here. You can stay up to date with us. This is my plug for us internally. There is on the website, you can go in and click and connect. Don't, because of the regulatory issues, field a lot of shareholder phone calls and messages in between earnings releases and updates. I can't tell you what's not already public. I don't want to end up in one of the orange jumpsuits. So if you want to stay absolutely current and up to date on what's going on at the bank, if you sign up on the website, every press release that we send out, whether it's picked up by the press or not, you will receive it and you'll have a great update in what we're doing and where we're at. We do an awful lot of things on kind of the social media side as well. We do in the Facebook world, the Like First IB Bank, you'll get little blips and snippets from us and kind of keeps you up to date on the news. Virtually everything that comes out on Bancorp is really First Internet Bank. They're one and the same in operation and day in and day out view. So this is just a great way for you to really stay on the forefront of everything out there. I will take phone calls and I will talk to you. Love to talk to anybody, shareholder, investor in the bank, but just understand up front, I'm kind of limited in what I can or cannot say in between announcements and particularly quarterly earnings reports. We thank you very much for your support. 2011 was a fantastic year. We're off to a phenomenally strong start in 2012. And as I say, just as we think everything's really rocking and going well, I read an article in the Wall Street Journal, kind of front page today, that they're anticipating that I think they're calling it cliff financing, that the tax is going to, all the tax incentives are going to expire, the budget cuts that are going to be forced, et cetera, et cetera. There's like 3 or 4 items that are going to all hit simultaneously this fall if the legislature doesn't get off their duff and fix it. And if that happens, they're anticipating we're going to have a 5.1% drop in GDP during the first quarter and basically pushes into another mini recession in early 2013. So, Washington can do what it wants. We try to do everything we can here in the Midwest to keep things running in our world and moving forward. So again, thank you very much for your support, and we appreciate you coming out today.